You've been there, right? Staring down a huge decision. The stakes are high, and the right path is, well, it's not obvious at all. Today, we're diving into a framework built for exactly those moments: cost-benefit analysis. Think of it as a way to move past just a gut feeling and start making some really smart, data-backed choices. So, let's put you in the hot seat. Imagine you're the CEO. You've got a massive decision on your plate, one that could define your company for the next decade. The question is simple. Do you pull the trigger and invest billions in a brand new factory? It's a gigantic risk. I mean, where do you even begin to unpack something like that? Well, your first instinct, and this is what most of us would do, is to just make a simple list of pros and cons. On the one hand, hey, more jobs, higher revenue, market growth, all good stuff. But on the other side, you've got that massive initial cost, the potential environmental headaches, and the disruption to the local community. It's a decent start, for sure. But when we're talking billions of dollars on the line, a simple list and a gut feeling just isn't going to cut it. You need something way more rigorous. So here's our game plan for this explainer. We're going to start by seeing why that simple list has its limits. Then we'll get a clear definition of what cost-benefit analysis really is. From there, we'll open up the classic toolkit, see how it's been upgraded for our complex world, and then we'll take a peek into the very cool future of decision-making. Right, so that pro-con list is a good starting point, but it's got a pretty major flaw, doesn't it? It doesn't tell you how much each of those pros is worth, or how you compare something like higher revenue to community disruption. For a decision this huge, you need a real system to avoid making a very, very expensive mistake. So, let's get into it. What exactly is cost-benefit analysis, or CBA, as you'll often hear it called? And how does it take a tough call from being a guess to being a truly calculated choice? You know, at its heart, cost-benefit analysis is all about being systematic. The whole goal is to put a number, usually a dollar value, on every single cost and every single benefit that's tied to a project. And this is absolutely critical for those giant decisions, like building a factory, where one wrong move could cost you millions, maybe even billions. And this right here is where CBA gets really powerful, especially today. It's not just about the money anymore. A proper, modern analysis has to balance these three key things you see here: the pure economic impact, sure, but also the environmental fallout and the social effects on real people and their communities. Okay, so let's pop the hood and look at the classic toolkit to see how this works in practice. For decades, a few core financial metrics have really been the bedrock of cost-benefit analysis, giving us those solid numbers we need to guide our choices. First up, we've got net present value, or NPV. Now, its genius is that it's built on a really simple truth. A dollar in your pocket today is worth more than a promise of a dollar tomorrow. So what NPV does is it calculates all the money you expect to make and spend over the entire life of a project, and it boils it all down to one single number in today's dollars. It answers that fundamental question: is this thing actually going to create value? And the answer is pretty simple. If your NPV comes back positive, like this $5.2 million figure here, that's a huge green light. It basically means the project is expected to earn way more than it costs, even after you account for the time value of money. So, financially speaking, it's a definite go. Next up in the toolkit is the internal rate of return, or IRR. Think of this one as the project's own personal annual growth rate. It tells you how efficiently your investment is actually working for you. So while NPV tells you how much value you'll create in dollars, IRR gives you this nice, clean percentage that's perfect for comparing totally different kinds of projects. Now, you always measure the IRR against some kind of minimum target. People often call it a hurdle rate. Let's say your company's hurdle rate is 10%. Well, if your project's IRR comes in at 18%, like it does here, it is easily clearing that bar. From an efficiency point of view, this investment is looking really, really good. And finally, we've got the payback period. And this one is just refreshingly simple. It answers the one question every single investor wants to know. How fast do I get my money back? Plain and simple. The faster the payback, the lower the risk. So these classic tools, NPV, IRR, payback period, they're fantastic for answering one very specific question: will this make us money? But they can be a little short-sighted. They don't always account for long-term sustainability or those non-financial factors we talked about. And that is exactly why the field has evolved to think bigger, to look at a project's entire life cycle and balance goals that sometimes even conflict with each other. Which brings us to the advanced approaches. Think of these as the essential upgrades to our toolkit, designed specifically to handle all the complexity and uncertainty of real-world decisions that go way beyond a simple profit and loss statement. So this is how we upgrade that toolkit. First, with lifecycle costing, we stop thinking about just the upfront sticker price. We analyze every single cost, from the moment a project is born all the way to its disposal. Then, with multi-criteria decision-making, we get a structured way to weigh things that aren't just about money, like trying to balance project safety against project cost. And finally, robust optimization helps us stress test our decisions against the unexpected, really preparing us for those worst-case scenarios.
And this is where it all gets really exciting. We are now in an era where technology is literally supercharging cost-benefit analysis, transforming it from a simple calculation tool into a full-blown predictive powerhouse. What this means is we can now integrate some incredibly powerful new tools right into our process. For instance, we can use Monte Carlo simulations to run thousands of what-if scenarios, seeing pretty much every possible outcome. We can layer in geographic information systems, GIS, to understand how costs and benefits actually change depending on the location. And, of course, we can now leverage machine learning to forecast future trends with an accuracy that was just science fiction a few years ago.
So, when you step back, the journey of cost-benefit analysis is really one of increasing sophistication. It's grown from that basic pro-con list we started with into this dynamic, multifaceted, and now AI-powered framework that truly helps us make those massive, complex decisions that are going to shape our future. And all of this leaves us with a pretty fascinating question, doesn't it? As our data and our analytical models get better and better at telling us the right answer, what happens to the role of human experience, of wisdom, of good old-fashioned intuition? It's the new balance we're all going to have to find.